Why don't we start with kind of what are the key things in terms of building and growing a massively sustainable business that lives hopefully forever. One of the things that's interesting about being $1 profitable and $1 unprofitable is the difference between immortality and death for a company. And so I think I'll first point to Hans Peter and say, what do you think the fundamentals are from starting from scratch and building out to that kind of company? Or do you want me to start?
I was going to think, why don't you start that one? Well, yeah, you start that one, Reid.
Okay.
I'll chime in.
So in consumer internet, one of the key things, and some people may have heard this from me before, is how do you, is you have to first get to a certain scale. There are some consumer internet businesses, Enterprise 2.0, SaaS stuff that you can start with a business model and kind of chunk up, but for social media, social networking, and e-commerce, by the way, is also another place where you can kind of scale up. But the other ones, you have to get to massive scale. Otherwise, you basically have nothing. So focusing on growth first, then engagement, then revenue, is the general social media pattern. Now, that doesn't mean you shouldn't think about a business at all, but it means that however it is you're going to solve your distribution problem is the way that that's the configuration that you have to solve the business model problem for. So for example, I'll give you a concrete example. When Yelp launched, Yelp thought it was going to be Friendster but with a purpose, and it was going to have email viral invitations as a, the way that it was going to grow. And what they found when they launched is nobody was sending out invitations from Yelp. They thought, oh, but we had this purpose and people were going to be sharing restaurants, and that's what was going to drive the growth. And in fact, it didn't. But what they did, and so in the first 6 months, they kind of thought they were dead. But then they figured out, I heard the second principle was always be on time, something like that?
First.
Yeah, first principle.
Sorry. It was the president.
Not my fault, in other words. So what Yelp did is they realized that actually they were getting a bunch of traffic from Google, right? And this SEO, and the way that their distribution model worked is, you had 100 people write reviews, 5,000 people came in, and then 3 of those 5,000 people added more people adding reviews. And so the stack on the SEO search got deeper and deeper, and that's essentially how they did their distribution. And then once they start getting distribution, they start figuring out components of how their business model comes together and what are the elements that make that work. And that's the pattern of first doing kind of growth of engagement, and then having been thinking about the business, but then configuring it specifically to business is a classic consumer internet pattern. And obviously, if you don't get to a business model, you're not a sustainable thing forever. But that's kind of an opening frame. And now I'll pass the baton again.
Pass it to me?
Yeah.
Well, the first word that came to mind was luck. I think I have a good friend who actually funded one of my earlier companies, and I'm not sure he's the best consumer internet guy out there. I think that's, it's probably Reid, so you got him in the room. But I think that my friend basically looks at it and says, look, it's kind of like betting on Hollywood, right? It's in the consumer internet space. There's every day, every week we hear about cool new little things. I mean, Foursquare, several people pointed to that today, right? Well, guess how many Foursquares there's been already, right? Foursquare-like things. Foursquare just got something right, timing, a little bit of luck, and some sort of secret sauce in terms of just how they unlocked it a little bit like a game, and now it seems like it's getting some initial momentum, right? And I'd argue that it's hard to argue Twitter being luck because the guys who started it were so successful in their last company. So when once luck, twice, really lucky, and 3 times you're actually pretty smart. And I think that in this case, clearly they're very good at what they're doing, and very smart. But the premise that Reid outlines, which is, I'll reiterate in my own words, is this idea of putting some initial idea out there and then iterating on it until you see pickup, and then staying very focused on growth over business initially, because until you have the audience, the business model doesn't matter. So that I think is a core premise, and I also think that since a lot of the dialogue has been about U.S. versus Europe, or U.S. Silicon Valley versus Cambridge, and the differences. I'm not sure the investment community here fully appreciates or understands or is willing to take those risks, right? I think, and even in Silicon Valley, many are not. I mean, it takes a relatively audacious bet to say, we're going to make a big bet on something where we have no real idea what the business model is going to be, but we're seeing enough pickup here, we're seeing a strong core team, we're seeing repeat usage, we're seeing engagement, and we're just going to invest in that. And then I think one other point is that I think you only get one shot at it per investment cycle, per company. So if you're going into a company and you say you raise a seed round of $1 million, if at the end of that seed round you don't have enough pickup that you're actually seeing a path where what you're really buying at the next level are servers and ops guys so that you can start scaling it, you're going to have a very hard time convincing somebody that they should that they should put the next 3 or 5 in, because you're running an experiment with a relatively small amount of money, and that experiment isn't about the business model. It's about getting the dogs to eat the dog food, as I'm fond of saying, or getting unlocking some magic. And if that experiment fails, at some level the logic says shut it down and go run another one, but don't keep iterating on that experience, because that's going to get very painful for you. You're going to get diluted, or it's going to be very hard to do. And I don't know if Alan or Reid, or if you guys would agree with that, but that's the dynamic I've been seeing. And I guess one final anecdote on that is the same guy who sort of talks about the sort of hits-driven business, this, and that it's very hard to pick winners. He's also following in the footsteps of Accel, who invested in Facebook at a seemingly extremely high valuation at the time. Now kind of a brilliant move, but they put 20 million in at an 80 pre or something like that, at a pivot point where Facebook had basically demonstrated that the dogs were in fact lapping it up, and at that point, even without a business model, they were willing to step in. So you see a non-linear response. You see the function all of a sudden changing when you get that rabid usage pattern behavior, even if you don't have the business model.
I add one thing. I think, there's a lot, but I think what is important is the team that you hire, or the people you're working with. I'm sure you were going to mention that at some point, but having the right people in your company that are motivated, and hiring being consistent in hiring good people that you want to work with, I think it's very important for a company when you start early stage, and that's how you can communicate the culture. I think Google managed to keep that culture. It probably changed a bit, but for a company that is 20,000 people, it's still a very flat organization. Anyone can send an email to Larry and Sergey and get an answer. You obviously you have to come up with a few arguments if you want to make your point. But I think the team is very important, and also on the product side, I think it's getting more and more easy to build tools without being financed. I think bootstrapping is a lot easier now. You can use Amazon for storage, for computing, App Engine from Google. So I think it's a very good time to start a business, basically.
Mm-hmm. I'll add one thing and then also have you
What's
come.
the topic?
The basic topic is, how do you go from, what are the things you put in place, the foundation in the beginning, in order to successfully build a massive consumer internet company? It's kind of what the range looks like. There's a lot of it also interest in business models and that sort of thing as these things, as the game plays. Fundamental startup strategy frequently looks like it's product strategy, and it's not. It's financing strategy. Because you run out of finance, you die, right? And so now, very early stage, one of the good things about consumer internet is, and this is one of the reasons why even angels relatively rarely invest without seeing something of a product, is because it's cheap enough to get something going. If you don't have the wherewithal to get something going, that's badly predictive for the future, right? So generally speaking, in the consumer internet, everyone wants to see something. That's not slideware, it's something working and going. But what I mean by that the financing strategy is essentially core is that when I raise my Series A, I'm actually thinking about my Series B, right? It's not, oh, I've raised money, it's successful, I'm done. It's like, okay, I've done this, and now I'm going to be running this course. And it's not that you run your strategy based on financing, because you're ultimately trying to build this thing. And if you go wildly off course in kind of like, you know, a canyon, you can't get anywhere, you die. But the question is, you have to do this kind of island hopping. And so I think about, like, what is the things that you prove and you add, the momentum you create, the assets that you create, the direction towards that bigger picture that helps you jump between financing. And when I did my Series A in LinkedIn, I basically did it with the agreement and acknowledgement of my investors. I was like, look, I'm not going to put a single, I'm not going to make one effort at revenue between Series A and Series B. I'm not even going to try it, right? Series B, I'm going to raise based on having, you know, gotten a lot of people in the network, gotten usage up, that sort of thing. And then after B, I'm going to work on revenue. It was the right play. Now, plays are different for different things, but that, how do you kind of manage between it? And one of the challenges that you need to do is make sure that when you're building data for how your company is working, that you give enough runway to really try that data. Because in, for example, financing, there's a 2x2 matrix, which is you raise money before data and after data, and your data is good and your data is bad. If you look at that 2x2 matrix, the data bad after, try to raise money after data is usually the death box, right? So you try to avoid that.
There's a skull and crossbones.
Yes, yes, exactly. So generally speaking, if you can raise money before data as an entrepreneur, that's the principle. And even though, yes, you might have gotten a better valuation or something else, right? That's better. Now, the other consequence of that is frequently you need some kinds of data. Once you've been raised money, you start doing it, you need some data as part of it. Well, to give yourself enough range to have worked on and iterated and tried to get it happening. So, for example, at the beginning of LinkedIn, you know, in April of 2003, the 4 VPs I had, and I sat down and said, we can't launch yet. We have to build this thing called Contact Finder. You know, people won't understand how to use it, and we still have the spec for it, by the way. I plan on building it at some point. And I said, no, let's launch and see what data you initially need to get. And as it turns out, what we needed to start working on right away was the whole invitation process and how people got invited into LinkedIn. And then we learned from doing that at a very fast basis. And so that kind of what data you're bringing in each financing is part of the strategy. Anything, Alan, you want to?
Having not heard all the background, I might be a little off topic. If I do, one of you hit me and I'll be quiet. I think there's one thing that is interesting about business-to-business businesses and business-to-consumer businesses that makes business-to-consumer businesses harder. And in businesses that are selling stuff to businesses, I'm joking when I say it's easy, but it's easy to go around and find out what the customers want, because you go around and interview them. And there are people in companies who are your customer set who will sit down and talk to you and give you feedback on your product. When you're building, especially on the web, a consumer-facing product, you have to take an entirely different approach. And it's much more test and repeat and change and test and repeat and change, because there aren't very many good ways to go ask consumers whether they like something that you haven't built yet. There's a big industry called the focus group industry that tries to do that, but it's very bad. And it is, I believe, a complete waste of time when you're asking panels of consumers to talk about something that doesn't exist yet. They do have good uses when you are comparing products or other more mature sort of product marketing kinds of features. So I think the approach you have to take if you're building a consumer-facing web business is to not try to design too much, but in a sense put stuff out there. And the beauty of having a business that's web-based is that you get a lot of data about usage. And so it's try, test, try something new, test, and let the feedback that is this wonderful sort of attribute of a web-based business that sells to consumers, let that be some guide or help guide the product direction. This when I've said this before, it has been easy to misunderstand, which probably means I don't articulate it very well, because it's not unusual for somebody to come up afterwards and say, so it's just try anything. And it's not at all try anything. You do have to have, one of Reid's great strengths is he has a very mature, strong product sense. But if you haven't already said it, he would say it, and if you asked him the question, that a lot of what they've done at LinkedIn is try stuff, get feedback, tweak it, try it again, get feedback, and iterate quickly on product features. But it's not random. It's driven by an overarching vision that Reid has, and so it's that combination. I was going to mention finance strategy, but I think Reid did a good job on that. The one feature I add is I sometimes say, because I spend nowadays most of my time investing in very, very early stage companies. I refer to them as a guy, a gal, a dog, and a PowerPoint. And
on the internet, no one knows you're a dog.
And on the internet, no one knows there's. It might not even be a dog. It might be a cat. But when you raise money in a consumer internet company, it does involve a lot of strategy. And one of I call it the price to dream ratio. It's good to have something that's gotten a lot of usage that you can imagine, extrapolating the growth rate into the future forever and having the company be worth $1 trillion. And that's actually a good time to raise money, because investors who see that kind of growth have what I call a price to dream ratio in their heads that's much higher than a price to any other line item on your actual income statement. So raising money while you've got traction before you have any revenue is actually an art in this business.
Yeah. So since one of the things that you guys seem to indicate interest in was consumer internet business models, let's switch. And by the way, roughly in terms of structure, because I'm much more a fan of interactive, I'm going to do a prompt with enough content to stimulate thinking, but I'm going to try to get this into questions and discussion with the audience within about the next 10 minutes, if not sooner. But what I'm doing with these questions is to prompt initial things out that may stimulate additional questions. So now we're going to move to business models. And one of the things is, the questions frequently around the consumer internet is, is advertising the only business model? What happens when markets such as crashes lose confidence in it? And C, are there interesting new kinds of business models coming about? What is the things that the people who are thinking about starting or participating in starting new consumer internet businesses, what kinds of areas should they look for interesting revenue streams and business models? And I think we'll probably just continue the rotation this way.
Okay.
So Hans, go ahead, start, and then Hans Peter. No.
Go first.
Yes.
I go first?
Yes. As you
Advertising on Google.
Yeah.
So that's the obvious answer. But as you said, that's like all the companies changed in the last year their business model. It used to be only like get users, get money from advertising and nothing else. I think what we've seen is more and more new business model coming in. So I'm going to mention two of them. I think freemium is so the Flickr example where you get lots of your audience and you convert one part of it. So again, it's all about measuring how many people you convert. So you have a funnel, you have all those users coming in, and you want to convert, could be 1 or 10%, depending on your business model, to be paid members. So I think that's something that is very interesting, because you can start building your audience without commitment, and you can offer new features for premium members. So in the case of Flickr, I think if you're a free user, it's limited to 200 pictures. So Flickr is an old model. I think what is hot right now in the internet space is microtransactions and all this. So I mentioned Playfish in the session before, but I can mention Zynga. It's how you create a relationship with your users on the free business, and then you hook them in and you get them to start paying for virtual goods. I think that's something that is starting to appear. Obviously, you have to do it very carefully because you can lose your customers. But I think that's something that is going to be big, or actually it's already big. Facebook is, I guess, going to launch that. And so if any of you can build a mobile payment solution or payment solution for internet linked to how you can easily buy those virtual goods, I think it's likely to be a successful business. So those, obviously you have other business models.
Payment solutions are very difficult, I know from PayPal things, so don't blindly
Yeah.
jump over
Yeah,
that cliff.
I'm just saying.
Right, but
It's hard to build.
yes. Hans Peter?
Yeah, I would agree. Freemium is interesting. I think microtransactions, both on the sort of virtual goods side as well as, I keep waiting for micro payments around content to kind of emerge in some way as well. And would argue that iTunes has kind of done that in a pretty successful way, but that we need it more generalized. We need a platform that allows you to, buy and pay for media more broadly. I would probably, the one other thing I would argue add is just location-based services. I think I mentioned this in an earlier panel. I think it's a wide open space, and I think it's going to be very interesting. I mean, it's being able to walk around with this thing in your pocket and have it, vibrate every time you get close to, fresh baked goods between 7:30 and 9 o'clock in the morning. There's an endless number of interesting opportunities around how you can use location as a layer and sort of real-time triggers. I don't think there are very many yet successful examples of this, because I think it's a very significant infrastructure play to make it really work. But I think you're going to see it starting to emerge over the next 5 years, and I think it's a fertile ground for innovation.
Alan?
The peril of going last on a panel of really smart people is you don't have anything to add.
Actually, I'm going to go last.
Next to last is almost as perilous. I'll go to you.
So a couple of so freemium, I think, is one of the reasons why most consumer internet things have a substantial free component. Is the best way to get to enable and help distribution. If you put up a pay barrier at the very beginning, it's challenging. So that's one of the reasons that tends to be a pattern. And it's free. It either goes to advertising or microtransactions or subscription, right? That's a pattern that has been talked about. I think two things to add. One is I think there'll be interesting things coming out of kind of data patterns underneath it. So massive consumer internet sites generate a lot of data. I don't mean data selling the data. I mean products coming out of them, right? So for example, on a LinkedIn thing, it's like, oh, well, if you'd like to know how to become, the kind of an exec at a software company, here's a set of paths to it. So in terms of analysis, I'm not saying that we're going to necessarily charge for it, but that's the kind of data product you can think of. The other thing that I think is more interesting and to the point is people frequently put all of their juice into trying to innovate around the product and the value proposition, which is a very good thing. But you also innovate on the business model. And so, and part of the reason in this case I'm using a LinkedIn example is because while I know some other interesting things about other companies doing, I don't know if I'm allowed to say them. But for example, like on LinkedIn, we have we're working on this thing called direct ads, which is where individuals, say for example, lawyers can advertise to venture capitalists. Of course, that would be Alan advertising to himself. Right.
Great rates.
Yes, exactly. And also, things like, for example, white papers. So white papers are commercially produced with real information in them that are targeted at certain kinds of professionals that they will then pay you lead gen fees to get in front of. And the professionals actually want to see them because that's actually content that helps them do certain kinds of jobs. And so pulling that together as an ecosystem is the kind of thing that we're looking at layering into the advertising ecosystem at LinkedIn. So advertising is not just do AdSense, do display ads. It's a wide variety of things that can include innovation in terms of how you're thinking about what you're doing. And that's something I would say is to think carefully about in terms of the initial construction. So I'm going to go to the last kind of our initial prompt questions and then shift it to a more general.
I actually had a question for the panel based on the freemium model, and that is, would you, in any of the businesses you've started or run, would you ever charge later in the company's life for something that used to be free, or would you only charge for new features?
So it's better if you charge for new features, but ultimately you charge for the thing that you need to charge for. So PayPal is the primary example of the charge for something that used to be free. So PayPal grew massively fast based on handing out free credit card transaction processing. So you could use, paying on eBay with, hey, it's use PayPal and it's all free, and PayPal absorbed all the credit card costs. And if we could have, we would have left that free, because the strength and level of user revolt on oh, by the way, that thing used to be free, now it's charged, is very high. But when we analyzed how to construct a business model, we learned, look, this is a very high, everyone thought that the money that PayPal was really spending was bonuses for people inviting people or fraud, and those were real dollars. But the actual real exponentiating cost stream, because we had exponentiating transactions, was free credit card processing. And so it's like, well, that's the principal cost line, and if our revenue line does not correlate with that, we're dead, right? There's no other way to do it, so we have to charge for that. And that we just have to do it, and so we're going to do it, and so the thing that was previously free is now charged. Now, we pulled all kinds of techniques in order to make that work well, and we actually have done it, I think, as good as anyone I've ever seen do it. We went from 0% paid to 88% paid in 6 weeks with no downward reflection on the general growth, right? We were like, wow, we didn't expect it to work that well. It was quite handy. Now, that being said, what I think is the normal consumer internet pattern is you put in a bunch of stuff that is essentially free, and then the way that you start doing either microtransactions or subscriptions is you add new things into it. Because you, generally speaking, don't get nearly, you get a couple of user complaints, but generally speaking, it's like, look, I get it, I was getting that for free, I continue to get that for free, and now you're offering me something new, and that something new is something I pay for. Okay, I get it. Like, people understand that that's the way it plays out. But that, anyway, that's I think the general pattern, but I don't know if you guys would add or change to that.
Let's go to
I was just going to say, I think another company which had the same thing happen was Meetup.com. So I think they
Yes.
got really popular
Yes.
at the elections in 2004, then they realized they need to charge for the Meetup. And it took them about 3 or 4 years to get back to where they were, because
Yes.
the users were used to paying that for it.
Yes.
you can look at this as classic demand generation stuff, right? I mean, if you're sending out a direct marketing campaign in the mail, it costs you money to send it out, and you'll get a certain number of pre-qualified and a bunch of leads, presumably. A bunch of them will never materialize into any kind of revenue. There's a cost associated with it. If you're using viral techniques to drive people into your system, and you're giving it away for free, it's not really free. It's free to them, but it's costing you servers and the manpower and everything to power it. At some point, you have to potentially flip the switch, right? At which point you will lose a certain segment of those users. I think it's a calculated risk, because if you lose enough of them in a sort of viral social business, then it's no longer viral and social. If you can maintain enough of them but lose some of the ones that you might never have been able to monetize anyway, then clearly it makes sense as a business. So part of it might also be an interesting kind of question to explore. Might be say Alan's one of Alan's companies was looking to start charging for a previously free business. How do you do that? How do you run some tests against it to see kind of the percentage drop off, etc., and do it a little bit carefully? How do you maybe even reach out to your guys and say, look, guys, this is costing us a lot of money. We need to charge for it, and literally start a dialogue with your user base if you can afford it. And there's lots of, I think, creative ways where you can involve your users almost in some cases in some of these conversations. Although, of course, the ones who say, you filthy capitalist pig, this should always be free, will probably have the loudest voices.
Loudest and soonest.
Right.
I can talk about Google, because we're obviously known for launching products for free, but we're still very careful about our costs. So Gmail was launched with one gigabyte, or Picasa is 1 gigabyte, and you have to become a paid user to start using more storage. And obviously we try to keep it as low as possible. We just double the storage for the same amount of money, but we still need to keep our costs. But I think we never launched a free product and charged afterwards. It was free, but always capped. And something that I think not many people know, but the first business plan of Google was to sell the technology to other companies. So we still charge for web search. And from the beginning, Larry and Sergey always said, we are going to make money from that. And even now, companies that we actually pay companies for syndication, so they syndicate their search, but we subtract a small amount because they pay us for web search. It's completely insignificant for them, but they still pay for it.
So,
What about Last.fm?
Uh-huh.
As an example of something that went into
So
planning.
people don't know I was an investor in Last.fm, but yes.
No, I didn't
Yeah.
know that.
Oh, yes.
I didn't know
Okay. So go ahead with the question. I thought you knew, but that's fine.
No, sorry, I really didn't know. No,
Yeah.
I think it was just the last example I saw of a company that was completely free and got quite a huge momentum of
Yes.
followers, and then suddenly decided to go on and pay something on the pages.
Yeah.
In that case, basically you cannot really use the service without paying, so it's basically take it or leave it.
The basic thing, and this is one of the things that's always troublesome with the music business, is it's very difficult. The free is what gets you a lot of adoption, but given the music licensing requirements, there's a cost structure that comes in behind it. And how services do that juggling the right way is very, very tricky and difficult, right? So, okay, so I'm gonna do one last panel question, and then so you start thinking about what it is, what kind of questions you guys would like us to talk about. You start the company, you get it going, you have goals and so forth. Should you target the company at an acquisition exit? Should you target it always at an IPO exit, or some blend of them? What's the logic of thinking about the exit strategy as you go through this? And one of you can volunteer. I won't pick on one, or I'll pick on one if none of you volunteer.
So I'll take a stab. I think there are cases in which it's clear that the only exit for a consumer startup consumer internet startup is through an acquisition. And in my practice, where I invest in do seed and angel kinds of investing, a number of the companies that I've invested in, I do it with the understanding that they won't need to raise more than $1 million to achieve their business goal, and the outcome is to be sold for somewhere between $10 and $20 million. And that's actually quite a good return for the investors as well as the founders if you don't raise more than $1 million. The ratio of money raised to exit value, as I don't need to tell anyone in this room, is the critical determinant of the return on your investment, whether you're an investor or a founder. So there are clearly firms that are doing what I would sort of, in a very offhand way, call sort of freelance outsourced R&D, on the hope that Google or Yahoo or Microsoft or Viacom or Disney or somebody will buy them. At above that layer, I think it's very hard to design a company to be acquired versus to go public. I think, and I'm leaving aside the problem that overarches this whole discussion, which is in the U.S. anyway, the dearth of the death of the IPO market. But I used to tell, I've been had 2 careers. I was a lawyer for a long time, including representing Reid, and I've been a venture capitalist for the last 11 years. And I told my clients, when I had clients, and I tell my portfolio company CEOs, now that I have portfolio company CEOs, that your job isn't to try to design the company to be sold or to go public. Your job is to build a fast-growing, profitable business. And when I feel especially glib, I say your job is to accumulate opportunities. And I think that's the right approach to take. In some earlier conferences that Hans Peter and others were in with me, we talked about a version of this, and it's a way of thinking about it is the way to be successful as an entrepreneur is not to worry about your exit, but just build the business into a big, profitable, fast-growing business.
So what I'll add to that is, having just sold, that I think there's a very different dynamic between when you are in an opportunity, sort of an upmarket with, a hugely growing, successful, either through revenue or consumer adoption business, and want to sell, versus when, those are relatively the exception. Like in most cases, you're either selling because you're distressed and you're just trying to kind of, park this thing somewhere, or you're selling in, as was my case, in a, with in a difficult market situation where you were faced with the options of, you know, valuations that were not attractive ultimately, and a long path to, you know, a lot of good favorable stuff, but a long path to success, or an outcome that, you know, was objectively the right outcome for the business. And I think those grayer situations tend to be a lot more difficult to handle, because, you know, if you're Twitter, you're going to have guys knocking on your door every day and wanting to dance with you, right? And they're going to be very very flirtatious. Most of you aren't going to be Twitter, and there are very few of them out there. And so what happens is everything in between is relatively gray, and sometimes you can get very good outcomes based on a sort of strategic synergy, product fits, people fits, and et cetera, which is what I would, you know, kind of classify our outcome as. And in other cases, you're literally just trying to say, you know, this team has worked really hard for the last 3 years, let's get them a home, and let's see if somebody can utilize the IP, the technology, the customer base, whatever. So in our case, you know, I was very deliberate. Once I decided to sell, I was very deliberate about it, and it took me a year to do. And little known fact is that, you know, the day we signed our term sheet and we entered into a no shop, I was probably about 2 weeks away from having a competing term sheet, which I had to walk away from because the pressure, basically, it was the bird in the hand. So timing and managing these things, and that would have ultimately impacted the outcome financially quite a bit. I ended up selling to the entity I wanted to sell to, so that was a fine part, but from a overall value creation perspective, it was different. So there's so many factors that factor into it, but I don't think, just to loop it back to the original point, I don't think you start a business saying, I'm going to flip this thing. I think no investor in their right mind would back you in that. You start it because you're passionate about the space, because you want to change the world, you want to provide some real value for end users. But then as you're doing that, you're also realistic in saying, what is, you know, the best path? And again, final point, I didn't exit my business, I entered another one. And, you know, that entrance is very exciting, and it's an opportunity to really take the business to the next level, as opposed to somehow exiting it. And so many companies say, when are you going to start your next company? It's like, I just did.
Lim, do you want to add anything? Or?
No, I think we should do a few questions.
Well, let me just add one thing to this. I agree with all the other comments. So one of the things I do, and I recommend this as a good discipline when you're the founder and entrepreneur, is to essentially always have a reserve price in your head for what your business is currently worth. And that's not mean that you're a seller, but when you're in the very early days, so you have this idea and you got to scratch on a piece of paper, you actually think it's worth something. Now, no one's going to pay for it what you think it's worth, you know, when it's a plan that's here, because that's what you think. That's the kind of the risk discount of what you think you can build to. But what that does is that helps you filter through financing events. Every successful company gets acquisition offers along its path, and makes you go, well, is this a good time to say, yes, this is interesting, or no, I should go long? Because generally speaking, when you're long and you believe very strongly in your future, your internal price will be much higher than anything that will come in, right? It's one of the reasons why you know, various of the companies that are big now have all turned down offers en route, right? Because they go, no, I've got this big thing I'm building to. But having essentially a reserve price and an internal rationale of why that is, and it doesn't have to be an exact, right? Sometimes it's going to be a range or whatever. But that's a good way of thinking about it. So with that, I'm going to switch to questions.
Great, thanks. So I've got a question for everyone. Panel, but it's just I'd be interested to hear people's thoughts on innovative and competing fundraising techniques to angel finance, or the very early stage embryonic fundraising periods. I mean, my company is post Series B, so disregarding venture capital and venture debt, we go back and rewind to angel, when actually I think the dilution is pretty critical, because you're pre-data quite often because you simply can't afford to get the data, or if you do have the data, you bootstrap things, so you have a little hunch, but usually nothing more than a hunch. So you can't value so high. And just to give an example, Will King, it's not in online, but he does the King of Shades brand, you know, the shaving thing. he just did a fundraise where he effectively sold shaving bonds, and it was quite consumer. It was all wrapped up in a nice little package. So you effectively bought a, whatever it was, £5,000 loan into that company, and they sent you a mirror with all the certificate on, and it's quite kind of out there. But it worked, and I think he raised I did something small, like I think it was before the stage of companies in, like a couple £1 million. And someone else set up a machine online so that consumers and their customers could come in and actually take shares in their company. And I wonder if anyone had any ideas, on how to extract value and create a competitive environment at the very, very initial stages in a very innovative way.
Well, it's an interesting question. I don't know if would any of you want to start with this, or?
I'm not sure I understood the question. Is the question, have we seen any?
Other than angel financing, where you go to angels, are there other patterns by which you can go to early stage pre-data finance?
Yeah.
Sell something.
Credit card founders.
Yeah.
of the fund.
Mortgage, house mortgages are a common one.
Or sell something people want to pay you for right away.
Yeah.
I mean, that's my favorite.
I mean, the general challenge, I'll just say one cautionary thing. It's good to be innovative and creative. On financing, where people have shares and everything else, it's one of those things that can go terribly bad, right? So, for example, one of the things that can be very destructive to a company is, even say, for example, you raise $10,000 or pounds, and all of a sudden that investor is unhappy and wants their money back and everything else. That can be enormously destructive to a company, right? So, one of the things I think you need to do in startup strategy is focus on which hypotheses will make your thing work, right? Like, will the product be adopted? Will the growth pattern work? And try to not adopt too many. One of the problems entrepreneurs tend to have is, I'm going to innovate on everything. I'm going to innovate on management structure. I'm going to innovate on, and you're like, no. Innovate on the core set that makes it go, right? And then try everything else. Just try to make it, work as advertised.
I've got a question sort of weirdly linked to sort of innovative ways to raise fund sort of the idea of e-commerce and entertainment combined. And so the broader question is, what sort of particular areas within the consumer web are exciting you at the moment? So is this convergence of entertainment and e-commerce? Is it real-time web? Which bits are exciting you?
I'll get back to location. I think location-based services is very exciting right now. I do think the real-time web in all its forms. I mean, it's very focused on search, of course, with Twitter and Google and Facebook kind of figuring all that stuff out. But I think there's all kinds of real-time in general, but that's going to be real-time communication, real-time experiences, and I think location is actually going to play significantly there. I mean, the last time my jaw dropped when I saw was when I saw the Yelp app on the iPhone, that where you can walk down a street and just you see the little that was something I've seen on a lot of conceptual videos for the last 10 years, but all of a sudden it was real, running on a phone with so I think I think location's really an area of that I'm very excited about.
Problems, you won't have anything left. Oh, I'm sure you will. So location-based services. You mentioned Foursquare. I think they managed to come up with a new idea. So it's been there for a while, just location services, but this simple concept of checking in and starting a competition with your friends to become the mayor of a place. I think that's the little thing they do more. Real-time web, and I think mobile payment. So I've been looking at what so Vodafone is doing that. Safaricom is doing that in Kenya. So mobile payments between users. So as long as you add value. So in their case, they have a massive distribution network where you can send payment from a phone to another, and people are ready to pay for that because it's more secure than taking the bus, bringing the cash to somewhere else in Kenya. If someone manages to replicate that in Western Europe or in the US, I think it could be very successful. Maybe you're investing in a few companies now. I think that there are a few investments in the UK VC community.
Yeah, we've actually just made an investment in an American company called Link Nation, which is mobile payments.
What's
Okay,
this?
yeah, so I knew there was something.
Yeah.
Okay.
He's good.
I'm sorry.
Yeah, no, he's good.
Boy, that was a dumb investment.
Anything you want to add? Or?
I think all of the categories that have been mentioned to date, I agree with. I think there are interesting opportunities in e-commerce, particularly in sort of social shopping kinds of applications. So I would add that to the list. And I think there are lots of interesting, what I call B to B to C opportunities. As more and more businesses sort of run on the web, providing infrastructure services to those businesses, I think, is or can turn out to be an interesting line of business. Ranging from, I'm an investor in a number of those companies, ranging from providing outsourced video transcoding in the cloud to web publishers who increasingly need to provide video to their users in a bunch of different codec formats, to companies providing online publishers with various kinds of widgets that allow them to make the content on their sites much more interactive and engaging. So I would add that as a broad, it covers a multitude of sins, but as a broad category.
My last two investments were ad networks, right? Because I actually think there's some interesting stuff going on there. And then games was the one before that, Zynga, for example. Other questions? Question?
When looking to build a business model that may be cross-continental at some point, is there any preference in terms of building it in Europe or the U.S. versus Asia? Asia has scale and growth, but maybe not the pricing power at certain points due to discretionary income. However, the U.S. and Europe have maybe more consumer demand, but maybe not the same market. But if it eventually will spread, is there a preference of order of first, second, third, or in terms of geographic build-up?
Thoughts?
My sense, you know, it depends on you. You know, if you sound like you're from the other side of the pond, so that might be a natural place for you to start. You understand the psyche better, especially in the consumer internet. You have to understand and somehow have your finger on the pulse of the you know, the customer base, the consumer you're going after. And I think, having lived in Tokyo for a year and enjoyed it immensely, I never understood it. I still don't understand the things they do with their phones over there, although it's fascinating and compelling. I could never be the one to innovate into that, right? So I think you look at some of I think the mobile payment thing is huge, by the way. I think it's a very interesting space. You look what's happening in Kenya right now. And there's so many infrastructure, social norms, things that happen around these things that I would never understand walking into that market or that culture. So I think it starts there, and then if it is replicable, you'll probably never have time to get to those markets because somebody will steal your idea and do it in a culturally attuned way, and in some cases maybe not if there's some kind of infrastructure barrier or hurdle, and then you can obviously either, if you're very successful here, buy them over there or go chase them. That would be my quick take on that.
I think the geographic stuff really matters. It's easy. One of the advantages we have in Silicon Valley is you start with US and global English, and it's an advantage. As a business person, you take every competitive advantage you can get. It's a good one. But on the other hand, India and Asia have huge growth, and Europe is a very valuable market. That's actually difficult to have all the right cultural sensitivity. So it depends a lot on the business. Did you guys want to add anything, or good enough?
Same thing.
Good enough.
In any market, you need to understand sort of the local vagaries of the market. So if you have no experience in Japan or Korea or South Asia, either don't go there or partner with somebody who does. Same with Europe. For us, it's a much more natural, because we're more familiar with Europe. But I think they can both be attractive markets. But if it were Mars or Venus, I would say the same thing. You have to have somebody involved in your business who understands the local market.
Yeah, I want to ask about that elusive price to dream ratio. What makes a dream worth a price? Specifically, what I'm asking is, what characteristics do you as investors look for when evaluating whether to invest in a market? What characteristics make a market attractive?
Massive scale.
Yeah, I would say generally the price to dream ratio joke or trite phrase has to do with when there's a lot of traction in the business but no revenue yet. And and if the entrepreneur is attractive, then it's very easy to believe that the traction will continue forever, and you'll figure out a way with enough traction to make money. And sometimes that even works. And it can work in one of two ways. It can work, examples would be ICQ or Hotmail or YouTube, where those businesses, I believe, would never have become profitable as standalone businesses. Yet they were all acquired for, I think the smallest of those was $350 million, which was probably worth more today because ICQ was bought back in '96, I think. And I actually argued in a blog post that Twitter and Facebook are the same kinds of businesses. I may be proven wrong with Facebook, where the value of the business isn't the fact that it today is making money or that it might ever make money, but to somebody, whether it's Google or Microsoft or AOL or any of a number of companies who can take that functionality and spread it across a large network and figure out how to make money, that can be valuable. I mean, today I think Twitter is absolutely priced on a sort of price to dream ratio.
Questions?
I'm wondering if the
Excuse me, and may be undervalued.
talking about valuations, I'm wondering if the panel could talk a little bit about the early valuation of something that is like a subscription, not an ad-based model. Touched a little bit on subscription-based models, and I know that there are lots of ad-based models. There are many things that you can look at and say, well, in the best case scenario, we're going to be the next Facebook, or we're going to be the next LinkedIn, or the next Twitter, or whatever. And everybody kind of looks at that, and there's a known progress for, you know, what the best case scenario is, how long it takes to get there, or what the worst case scenario is. And those are kind of known figures. But it seems, you know, best case and worst case. But it seems to me that for the subscription-based model, there isn't really as much kind of information or examples.
Well, Alan was my mentor in my very first Series A that I ever did in terms of valuation, so I may throw you under this question.
It varies over time, and financial models come in and out of fashion in the investing community. Or the absence of a financial model is a impediment to getting financing or not, depending on the historical time frame. So that's probably the overarching comment. My sort of description of today's investing environment is that unless you are a company like Google, to be dependent on what I would call the media model. So you create content to attract users, to present marketing messages to those users, is out of favor. And other kinds of revenue models, subscription revenue models, actually have quite high multiples on them, although they tend to be smaller because they're harder to build. Today, all of the sex pheromones of the investing business are all around virtual good economies or virtual goods economies. And a number of companies, Zynga, which is a kind of canonical example, but Playfish is another great example. I'm on the board of a company called Slide, which is getting into this business in a big way. And I consider to be the final death knell of Western civilization, that the virtual goods economy would be as big as it is and growing as fast as it is. Those are very fashionable today, and it's not without reason, because they're essentially 100% gross margin businesses. So if you can create them and control your costs, you can make a lot of money.
You can make something out of nothing. It's a small amount of something, eventually they all end up.
Right.
Well, especially at scale.
Huh?
You got a follow-up question?
Yeah, I was wondering if anybody else had anything else to say about the subscription model in general, or
I like the subscription model a lot. I think all early stage financings are more art than science. So I'm a disbeliever in the model approach. It really, what it comes down to is you're really kind of sizing up, well, I think it'll grow to this. this is what I think later financings will, so this is the right risk reward ratio. I mean, all early stage financing valuation negotiations come down to kind of a, well,
That's what I thought.
yeah.
But I do think if you're doing, I mean, you know, Reid has a particular perspective because he lives in the valley and I think that is able and willing to sort of take big steps that I don't think most venture guys here in Europe would take. So I think you're going to have a fairly classic business model pitch if you're pitching in Europe, and I think that a subscription-based model is probably one of the ones that in some ways is the easiest to pitch because it's logical, it's rational. You can kind of put it together and you can say there's always the canonical, if you know, and then a miracle happens, right? There's always the and then something happens that makes it non-linear. But I think, in a rational sense, you know, I've run. In fact, we were, before we got acquired, our business model was to move very aggressively to a freemium model, where we had done a lot of investigation in the subscription space, and I'm very bullish on it. I think I think there's, but you know, it obviously hinges on a fairly significantly differentiated model that you can't get free somewhere else. But if you can get there, I think it's a rational model. It's one that kind of European type investors will probably be able to wrap their head around more because they can see step A, B, C, D, and then there's a business model and then it scales. So, you know, I would, if that's what you're looking at, I would encourage you to stick with that and look at kind of comps that you can use to justify, you know, your assumptions.
One last question.
Just around the idea of critical mass, I know you've sort of spoken quite a few times about the idea of building a critical mass of users of a website before you actually put a model in place. I just wonder, given a scenario perhaps where you have a model in place, an idea for monetising, what the role of collaboration with existing networks plays, and whether or not you've sort of seen case studies where someone comes along with an idea or a platform that can plug into an existing network. They've been bolted together through whatever sort of agreement, and it's worked. And also as a means perhaps of, if you can't get to the scale of network size quick enough, a means of doing that more quickly.
Well, personally, I find that the doing it through a deal and agreement is very difficult, because once you do that, the larger entity that you're negotiating with has all kinds of concerns about what they're giving up and how does it navigate. There are a number of things that are built off platforms. PayPal built off eBay. Zynga got its initial acceleration off Facebook. There's a number of ways to do that. Those don't tend to happen through, you know, a long negotiated thing. And I'm generally skeptical of that, because once it gets there, the structure of the deal and the risk, because all business ultimately comes down to individuals. So like a corp dev or BD person who did a deal where then all of a sudden it took off and it was enormously valuable, gets questions internally the organization of, you know, why were you giving away the keys to the house? Did you get enough for it? You know, that kind of stuff. And so it creates a lot of impedance, but you guys may have different views.
I'm skeptical as well.
Okay, I think that's time. Thank you very much. Give our speakers a hand, please.